We're continuing our discussion on Accounting 1120 long-term debt today. Still frozen outside, still snowing. Ugh. Let's look at our goal. Got my goal done a little better, a little more complete this time. We're going to demonstrate the goal for a bond sold at a discount using the effective interest method, which I left off saying on the last one, went back and added it, and a short demonstration of the straight line method at the end. Let's bring forward the facts. I know you already know what they are, but it helps if we have our cash flow in front of us. Here is our facts. Our bond indenture, the same one we've been using, $10,000, 10,000 semi-annual interest payment, so that equates to 5%, which gives us our payment of $500 every 6 months. It's a 2-year bond, same interest payment dates. The market rate of interest in this example is 12%, so our bond isn't as good a deal. You can get 12% if you go somewhere else. So the way we're going to fix that is sell our bond at a discount. Going to sell it at 96.53. I give you that. Don't show you how to calculate it. Times that by the face value of the bond. And you can see we're going to get $9,653 for our bond. The next thing we need to do is analyze YZE, my brain's frozen, the transaction by making an amortization, but you're good at saying that now, schedule. Wahoo. I'm going to put this on hold and bring forward the format. So here's our format. We have a date column. Cash is going to be paid at 5%. Interest is going to be at 6%. That's half the market rate because we're doing it semi-annually. We're going to amortize the discount, and we're going to have a bond carrying value. When we issue the bond, we're going to sell it for $9,653, and the difference between that and $10,000 is we're going to add to interest expense to change the effective rate from 10% to 12%, the market rate of return. What else do we know? We know we're going to make 4 cash payments of $500 because that's required by the indenture. We know the date's going to be 6/30/13 for our first payment, 12/31/13 for our second, 6/30/14 for our third interest payment, and 12/31/14 when the bond's last payment will be made and it matures. And now we need to complete the amortization schedule. So let's get started. 96.53 is our carrying value times 6%. It says interest should be $579, but we're only paying $500, so we're going to use up $79 of our discount. So let's add 79. Yes, it gets added because we need to take that up to 10,000, and that takes it up to 97.32. Completes the first payment. 97.32 times 6% is 583, and the difference between 500 and 583 is we're going to take $83 and amortize that out of our discount. Put that in. 97.32 plus 83 takes you up to 98.15. Next payment, 98.15 times 6% will take you up to 589. Amortize off $89 of our discount. Add that in, and that will take you to 99.04. 99.04 times 6% equals 594. So we would want to amortize 94, but you know what? We need to get to 10,000, and 94 isn't going to do it. 96 is what I need. So I'll go ahead and change this to 96. And I'll change this to 596. That's a big rounding error. I didn't carry out my decimals far enough when I came up with the selling price of the bond. It's bigger, $2 is more than I'm used to seeing, but it's all right. It still works. And so we adjust our last payment to be what we need it to be to get the bond to be fully amortized. So we've done the analysis now. Shall we make some journal entries? I know you're tired of this, but let's get it going. On 12/31/12, when we issue the bond, we get cash in the amount of $96.53. We set up a contra account, bonds payable, discount on bonds payable, in the amount of $347, and bonds payable gets, as always, the face value. So the bond is issued on 6/30/2013. You make your first interest payment. So you'll have some interest expense, which will be $579, and you'll pay cash in the amount of $500. The 500 is 5%, the 579 is 6%. The difference needs to come out of the discount on bonds payable, where we increase it by $79 since we sold it at a discount. So our first two entries are made. Then there's an entry on 12/31/13 where we say interest expense is $583. Pulling it from right there. Cash is always $500. It's the term the bond was issued under. And under the discount on bonds payable, where I tacked that additional interest, I'll take out $83.
Still snowing?
Hear that? Yeah, it's still snowing. And it's not snowing just a little bit. It's snowing friggin' hard. Even my kids are dismayed. How about you put this on pause and make the remaining 3 entries using the amortization schedule and paying off the bond at the end. Then come back and see how you did. How'd you do? First journal entry you should have come up with was interest expense of $589, discount of $89, and cash of $500. And the second entry, interest expense of $596, discount $96, cash of $500. Final entry, pay off the bonds payable. Yoo-hoo, how'd you do? Now, let's have you do something a little bit harder. Show me what the balance sheet would look like on 12/31/13. So you've amortized the first 3 payments. How would it look? Put this on pause and come back when you're done. How'd you do? I put down bonds payable, and then I put down the $98.15. I knew it wasn't backed into the amount of discount that I had left, $185. Well, that is the effective interest method. Let's take a quick buzz through straight line. We're going to take a look at the straight line method of amortizing discount on bonds payable, realizing that it's not generally accepted accounting principle savvy if the discount or if any significant dollar amounts are involved, and amounts that are involved are always significant with bonds. So in our example, we issued a bond at 96.53. So times that by the $10,000 bond, and you have a bond payable being issued at $10,000 times 96.53. This is how they publish it in the paper, so you don't have to be a math whiz to come up with prices of bonds. They're just shown through this mechanism. And you know that means we get cash of $96.53, and we set up a discount on bonds payable in the amount of $347, and we show the bonds payable at its face value. Then we're going to take the 347 and straight line it. $347 divided by 4 bond payments equals 347 divided by 4 equals 86.75. So we'll go with 87 3 different times and then plug the last payment. So here's the issue. Now the interest payments would always be cash of $500, and we're going to offset, we're going to increase interest expense by the amount of $87, so it'll be $587, and we're going to get $87 out of the discount on bonds payable each time. And we're going to do that entry 3 times, and then we're going to have to make the 4th entry work. So where would we be in our discount on bonds payable at this point in time? Start at 347, take out 87 3 times, and where would you be? Be left with $86 in there, and so the last interest payment would take care of that, and it would be interest expense, cash, and discount on bonds payable, taking it to 0. Take the 86 out of there, pay our cash of $500, and interest is $586. So you amortize straight line, take it evenly out of the discount account. And again, the appeal to straight line is you don't need the amortization schedule, and it's flippin' easy. But if it's any size at all, the difference would be material, and so it is not generally accepted accounting principles. When you realize most bond issues have about 6 zeros on them, beyond what I've been showing you, you'll realize that that is material. I kept it small because I thought it was easier to do that way. So now we've done 2 things. We've looked at the effective rate of amortizing a discount and the straight line way of amortizing a discount on bonds payable. We've looked at the journal entries, and we did a nice job of analyzing. That always comes before journalizing, so we did 2 ways of that. And then we analyzed, and we made some journal entries, and then we looked at how it would look on the balance sheet. I think that's some pretty good coverage of bonds payable. Thanks for joining me, and it's still snowing.